Welcome to the Opening Bell Report.
Today, we're looking at an analysis report on AMC, specifically its short squeeze potential, titled AMC Stock Alert 24% Short Interest. Let's get right into the first point. So a key theme here seems to be this constant look back to the 2021 squeeze, but the analysis, while correctly flagging the high short interest, needs to more rigorously integrate the impact of share dilution.
That is the absolute crux of the issue, yeah. As I see it, the report mentions under financials that shares outstanding have, exploded.
It's a massive number, something like 513 million shares?
Exactly. And the analysis correctly says this makes a squeeze harder than in 2021. But then, if you look at the history section, it compares the current price action to that famous 2021 run-up.
From $2 to $72.
Right. And the issue is, it does this without mathematically accounting for the sheer volume of all these new shares. It leans a bit too heavily on the price, being similar like $1.48 today versus those 2021 levels, and it just sort of glosses over the supply-side saturation.
I see what they're going for, though. It's a compelling narrative hook, trying to draw that historical parallel to get the reader excited. But okay, how do we strengthen this?
Well, the suggestion would be for the analysis to explicitly calculate what we could call the volume friction caused by all that dilution.
To see if a 2021-style move is even mathematically possible today.
Exactly. It feels like the report is relying on the muscle memory of the chart, instead of the physics of the market cap. So, for a concrete example, we could add a specific comparison of the float turnover rate required today versus 2021.
Okay, so instead of just saying, the float is massive,
which is a bit qualitative, right? Provide the calculation. You could literally say, in 2021, moving the stock $1 required X amount of volume. Today, with 513 million shares, it requires Y volume.
And Y is going to be a much, much bigger number.
Oh, way bigger. I mean, think about it. In early 2021, the company had what? Something like 100 million shares? Today, it's over 500 million. So a $2 stock back then meant the whole company was valued at maybe $200 million.
And today at 148, it's closer to 750 million.
Right. The stock price is lower, but the company is actually heavier. It just takes so much more buying pressure to lift a $750 million asset.
It's like the difference between trying to lift a compact car versus trying to lift a semi-truck.
Precisely. And the critique isn't that a squeeze is impossible. The critique is that the report asserts this potential based on a price level without adjusting for that market cap expansion. You could also show how the 24.25% short interest today represents a hugely different number of shares to cover.
Right, because 24% of 513 million is, around 123 million shares that need to be bought back?
And in 2021, 20% of 100 million was only 20 million shares. It's a massive difference in the wall of buying that's required. Showing that math transforms the high-risk warning from a generic disclaimer into a very specific, calculated obstacle.
That makes a lot of sense. It grounds the nostalgia in the mathematical reality of today. Okay, moving on. Let's look at the catalysts. The connection between the upcoming Q4 earnings and a triggered squeeze. It feels like it relies on a binary outcome that needs a deeper look.
It does. I mean, the forecast section identifies a cash flow positive announcement as the match that lights the fuse. It sounds exciting.
Sure.
But then you flip back to the financial section, and it notes a widening net income loss, almost $300 million, and these heavy interest payments. So the report assumes a positive cash flow surprise is possible without showing the bridge of how they get there from the current burn rate.
It's like stating the destination without checking if there's enough gas in the tank to actually make the trip.
That's a perfect analogy. The ambition is there, but the roadmap is missing. So to improve this, the suggestion is to really strengthen the Catalyst Watch section by stress testing the likelihood of this positive cash flow event.
Right, so not just stating it as a potential trigger, but how do we make that actionable? We don't want to just say, be more skeptical.
Well, what if we use a metric the analysis already mentions in the deep dive, the revenue per patron? It's there, but it's not really being used.
Ah, okay.
You could calculate exactly how much merchandise and premium food sales would need to spike to offset that massive $8.2 billion debt service cost.
You mean like actually do the popcorn math?
Yes, exactly. If the interest payments are hundreds of millions a quarter, how many extra tubs of popcorn does every single patron need to buy to cover that? If the math shows that every person needs to spend $50 on concessions when the average is 7,
then the reader knows a cash flow positive surprise is, well, it's highly unlikely. It moves the report from just hope into actual probability.
and furthermore, what happens in a neutral earnings scenario? The analysis presents it as a binary. Green means squeeze, red means 50 cents.
But what if it's just okay? They lose money, but a little less money than expected.
Exactly. Does the whole thesis just collapse? It misses that middle ground where the stock might just stagnate around that $1.35 support level.
And that middle ground is where so many traders get hurt. That's where options premium gets crushed. Ignoring that leaves a huge hole in the strategy for anyone reading this.
It really does. If the thesis is green or bust, and the report comes in yellow, the trader is left without a plan. Adding that nuance just makes the analysis so much more usable in the real world.
Okay, I really like the ambition of this next part, the pure comparison. The comparative analysis with Cinemark effectively highlights the valuation gaps, but it risks creating a false equivalency when it comes to financial safety.
Conceptually, it's the right move. The deep dive section contrasts AMC's 0.16 price-to-sales ratio against Cinemark's 0.95.
Which on the surface looks incredibly compelling. It makes AMC look like it's on an 80% discount.
To a novice, absolutely. But as we know, the market is rarely that inefficient without a very good reason. And this omits the enterprise value context.
Right.
AMC's cheapness is largely optical because the equity value is just crushed by that $8.2 billion debt load we talked about. Cinemark, on the other hand, has positive cash flow. Using price to sales in isolation, it really flatters AMC in a misleading way, doesn't it?
It does. It creates a false sense of security like, oh, it's so cheap, it can't go any lower. So to fix this, the suggestion is to refine the powder keg valuation section. You need to include debt-adjusted metrics to show why the so-called smart money is actually shorting it.
Precisely. It's like comparing the down payment on two houses without looking at the size of the mortgage. I'd suggest incorporating an enterprise value to revenue comparison, not just market cap to revenue.
And just for anyone listening who might be newer to that, enterprise value is basically market cap plus total debt minus cash. It's the price to buy the whole company, debts and all.
Exactly. And when you do that math, AMC's valuation just swells because of that debt pile. You can then explain that while AMC generates more revenue, double Cinemark's, the quality of revenue is actually lower because of that interest expense drag.
So every dollar of revenue at AMC has to work harder just to pay off the bank.
That's it. And then you can frame the trap narrative, not just as Cinemark being safer, but as Cinemark having the ability to survive a downturn. AMC's runway is getting short with only $365 million in cash against that burn rate.
Which makes the short sellers' conviction understandable. They aren't just haters, they're looking at the enterprise value.
Yes. And paradoxically, that strengthens the squeeze argument. If you explain why the shorts have a valid thesis, the debt, then you could explain why a positive catalyst would be so explosive. If they solve the cash flow problem, the entire short thesis just evaporates instantly.
That nuance is crucial. It changes the narrative from good versus evil to solvency versus insolvency, which is an actual tradable thesis. Okay, finally, let's look at the technicals. The analysis of the falling wedge double bottom provides a solid entry idea, but it lacks correlation with the days to cover metric.
I noticed that too. The report notes days to cover is 4.2 days, and that volume is drying up. It also identifies 135 as the line in the sand support, which is great, but it misses the opportunity to explain how low volume actually increases the days to cover.
So it makes the squeeze setup even more potent if a reversal happens.
Exactly. The dots are there, bullet point 1 is low volume, bullet point 2 is days to cover, but the lines aren't drawn between them.
So the suggestion is to synthesize the statistics section with the chart setup to really explain the mechanics of what a liquidity trap for shorts looks like.
That would be such a powerful addition. You could explicitly link the seller exhaustion, that low volume, to the 4.2 days to cover. Let's just break down the mechanic for a second. Days to cover is the short interest divided by the average daily volume.
It's a fraction, short interest over volume.
Right. So if volume drops, the denominator gets smaller, the days to cover number gets bigger just naturally. Even if short interest stays the same, if nobody is trading the stock, days to cover can spike. That creates the liquidity trap.
So the lack of interest in the stock actually makes the trap more dangerous for the shorts?
Exactly. If nobody is trading the stock and a short seller wants to buy back, say, 20 million shares to close their position, they literally can't do it without spiking the price themselves. There's no one to buy from.
So if a catalyst hits, they're all trying to exit through a door that has shrunk to the size of a keyhole.
That is the perfect image. The report treats low volume and days to cover as two separate statistics. They're the same story. Explaining that relationship explains the potential for this explosive volatility. You could frame that 165 resistance breakout not just as a technical level, but as the point where the rising borrow fee becomes mathematically unsuspendable for shorts.
It turns the data from a static list into a narrative of market mechanics, which is exactly what a sophisticated reader wants. It explains why the wedge matters, not just that it exists.
And it really clarifies the stakes. All these points are so interconnected. The dilution creates the massive float. The float requires huge volume to move. The current volume is low, which creates the high days to cover.
It's a whole systemic view of the stock.
Yes, and the cash flow catalyst is the only thing that can bring the volume back. If it's bad, the debt we talked about kills the equity. If it's good, the volume returns, the shorts get trapped, and the squeeze happens.
So really, all this feedback isn't about changing the conclusion. The conclusion that AMC is in squeeze territory could be perfectly valid, but the argument needs to be tighter.
Exactly. We're just asking for the dots to be connected in a more rigorous way. The raw materials here are excellent. The 24% short interest is real. The 135 support is a real level. The debt is a real problem. The analysis just needs to honor the complexity of how those things interact.
It moves the report from being a list of statistics to being a strategic roadmap. It helps the reader understand that dynamic between the smart money shorting, the debt, and the apes going long on the technicals. And a great report has to acknowledge that both sides have valid points.
The smart money isn't evil. They're reading the balance sheet. The apes aren't crazy. They're reading the chart setup. The trade lies in the tension between those two realities.
Okay, let's wrap this up by summarizing the actionable advice. It really boils down to 4 key improvements.
Right. First, don't hide from the dilution. Mathematically account for it. Calculate the volume friction and show the reader that lifting this stock today is just heavier work.
Second,
Stress test that cash flow positive catalyst. Use the revenue per patron math to see if it's even possible. And define the middle ground. What happens if earnings are just meh?
and the third point on valuation?
Use enterprise value, not just price to sales. You have to acknowledge the debt reality to explain why the shorts are even there in the first place. It validates the risk profile.
And finally, the technicals.
Link the low trading volume directly to the days to cover mechanic. Explain the liquidity trap. Show that low volume means the exit door is small for shorts, which is why that breakout level matters so much.
This has been a really productive teardown. We would love to see how you refine this analysis report. Please implement these suggestions and submit the next iteration for us to review. Thanks for listening.
Don't forget to like, share, and subscribe for more.